This is T3 Lesson 4. What we learned today really matters because when everyone looks one way, the market often moves the other way. Looking at Bitcoin's daily chart on screen. While price climbs, people keep wanting to buy. But if everyone already bought, who is left to sell to? With no fresh buyers, price falls. History shows big reversals when greed and fear hit extremes. The 2021 Bitcoin melt up near $65,000 of trading fever. The extreme fear of the 2008 financial crisis. Those extremes almost always arrived with major price turns. Today, we learn 3 ways to read that crowd extreme as numbers. This is real advanced level craft. First up, the Fear and Greed Index. Like Bitcoin's daily on screen, it measures extreme market motion as a number from 0 to 100. 0 to 25 is extreme fear. Everyone wants to sell. 75 to 100 is extreme greed. Everyone wants to buy. 46 to 54 is roughly neutral. Here's the key. When the index hit 8 after the 2022 crypto collapse, price bounced about a month later. When it hit 97 in the 2021 bull run, a pullback started about a week later. Think of it this way. When fear is at 10, it's like coffee dropping from $4.50 back toward $3 a cup, an extreme opportunity signal. At 95, it means everyone already bought. Who's left to buy next? The important part, at extremes, the odds of a reversal rise. That shows up in the stats. That does not mean a reversal is guaranteed, only that the probability went up. Second, the put/call ratio. This signal comes from the options market. Simply, bets that prices fall versus bets that prices rise. Look at SPY's weekly chart on screen. A ratio near 0.3 means options traders are heavily betting on upside. Near 2.0 means the opposite, heavy downside bets. At extremes, one side is overconfident. There's a familiar pattern. Put/call in the 0.2s, and about a week later, pullbacks often start. Above 1.8 for a few days, bounce signals often show up. But stay careful. An extreme ratio does not force a reversal by itself. You still want chart technicals, news, and other confirms alongside it, especially around Fed days when the S&P 500 can whip around. Third, the COT report. On U.S. futures markets, like the gold futures on screen, it publishes each week where institutions and retail traders hold their positions. In plain English, who is buying and selling big money, institutions, versus smaller accounts, retail. During the 2008 financial crisis, retail kept leaning short. Institutions quietly shifted toward the long side. A pattern keeps repeating. When retail crowds hard into one side, institutions often try to sit on the other. Institutions already have a view. So when COT positioning looks extreme, a reversal may be getting closer. Of course, this is not a 100% guarantee either. Market psychology usually moves through 4 stages. Follow along on Bitcoin's daily chart. Stage 1, quiet interest. Price is up about 10% and people around you barely notice. No headlines yet. Stage 2, news and word of mouth. Around a 50% rise, it spreads on social media and friends start talking. FOMO kicks in. What if I miss it? Stage 3, peak mania. Price is up about 150%. It's on TV, and you hear this time is different, and it'll keep going forever. Levered trading booms. Stage 4, collapse. The first wave of selling triggers a chain reaction. Price drops hard. This pattern showed up in the 1920s mania, the 2008 crisis, and the 2021 crypto bubble. Here's the single most important rule in live markets. Never decide on sentiment alone. Looking at SPY's daily on screen, ask yourself, if fearing greed is extreme but the chart keeps falling, the move is still alive. Check 3 things together. 1. Sentiment extreme? Index near 10 or 95? 2. Chart technicals. Did resistance break? Is it oversold? 3. Fundamentals. Is bad news still rolling? Did Fed policy just shift? When all 3 point the same way, that is a real turning zone. Example: extreme fear plus daily chart touching support plus constructive newsgraph, a buy-side setup to study. If only sentiment is extreme while the chart keeps falling and the news stays bad, wait. Stage May 4th still be underway. T3-4 wrap-up. 1. Fear and Greed Index. A thermometer for market emotion. Reversal odds rise at extremes. 2. Put/call ratio. A contrast gauge for how options traders are crowded. 3. COT report. A tool for institution versus retail positioning extremes. 4. Trust the signal only when all 3 align. T1 gave foundations, T2 gave technicals, and now in T3 we add sentiment to the judgment stack. Even Bitcoin's daily on screen looks deeper through this frame. Remember this last point. These indicators raise probability. They do not guarantee anything 100%. Always set a stop-loss plan first, then execute without emotion. That is real skill. This lesson is for education only and is not investment advice. It does not guarantee any profit, and every decision and its consequences are yours alone.